So because of how many variables play into construction and how cash intensive it is upfront, contractors are always running to this issue of not seeing these overruns in their budget until it's done significant damage to their bottom line, whether that's at a project level or at a company level. Luke, I want to talk a little bit today about how contractors can address that issue, how it should be addressed, and what they can do to catch those overruns before they become too big of a problem.
Yeah, I mean, the short answer is better project management, right? It's training processes and procedures at the project manager level and educating your team on how they need to be reporting on all of your jobs at the end of any given month minimum, if not week. And unfortunately, most accounting systems and job cost tracking tools and applications out there aren't really set up to do it effectively. Because all of them that I've seen anyways have a module where project managers can track job status in terms of job revenue, job cost, job profitability, and all those metrics you would normally see. And usually they have some function of estimated cost to complete for the project. Unfortunately, they all seem to use a formula to calculate estimated cost to complete. So you bid a job, it's $1 million project. You estimate that it's going to cost you $700,000 to complete that $1 million project. You're expecting a 30% gross profit. Halfway through the job, your costs on that project are $350,000. So half of the $700,000 that you estimated. You put all of those costs into your accounting application, your project tracking tool, whatever it is that you're using, and it's going to show you that you've incurred $350,000 in cost to date, and then whatever revenue you've billed on that project. And then it's going to have this super fancy column that says estimated cost to complete. And what is that number? Always estimated cost minus what we've incurred to date. So we said it's going to cost $700,000. We've incurred $350,000. Our estimated cost to complete is $350,000. The problem with that is your estimated cost to complete might actually be $400,000. If you think about the reality of how much cost is actually left to incur to get the job done, because maybe you had a sub that was high, they ran over. Maybe your labor force was inefficient, unproductive, and your labor hours are getting out of control. Your labor costs are going to be higher than you anticipated. None of that is going to be captured in a formula-driven estimated cost to complete that is just estimated job cost minus what we've incurred to date. Your project managers need to be trained on actually estimating what the remaining costs are going to be to complete the project. So that estimated cost to complete isn't some stupid formula that doesn't make any sense. It's a real estimate of how much money we think, how many real dollars we think we still have to spend to finish this project. Now we can see at the end of every month or every week, however often we're doing it, where we have project overruns long before the project is completed. We can dive in and figure out why early in the project and give ourselves a chance to course correct and fix it before we get to the end of the project so we can still end up profitable instead of finishing the stupid thing and figuring out our $700,000 of estimated cost came in at $900,000 and we're barely going to make any money on the job.
Yeah. So in other words, they would have to adjust the budget as they go to allot for, okay, we might have estimated this would be $700,000 to complete, but actually it's going to take $800,000 because of these overruns that we've had already. And then how do we address those and avoid them going forward in the project?
Yeah, and giving yourself a chance to understand why those overruns occurred. Like, do we have an employee that we need to replace because they screwed up a bunch of stuff, wasted a bunch of materials, didn't get stuff done on time? Did we end up having a project manager who just took on a bunch of out-of-scope work that he shouldn't have, where we should have billed change orders for that? Now we're leaving revenue on the table because we didn't have an effective process in place to identify cost overruns driven by out-of-scope work. Like when you don't have a way of seeing that stuff's happening early in the project, you don't give yourself a chance to course correct for it, whatever the cause is.
What do you see most contractors doing to address this problem? Like, obviously not every construction business is going out of business, so there's some way of combating it. What are most construction businesses doing to solve for this?
Yeah, unfortunately, I think the answer is nothing. Not that there aren't any out there. I mean, I'm sure there are gold standard construction companies out there that have dialed in processes to address this. But I mean, it's exactly what I just said, right? They recognize that their systems that they're using aren't giving them the information that they need. So they are doing training and developing their team to report on what they actually need. What are our real costs left to complete this job? Not some stupid formula. They're making the system do what they need it to do by either creating processes on the side or just configuring their system in a way where they can still get to the data that they need in more of a reporting structure. Short of that, there really is no way to fix it. Companies that aren't doing that are kind of just getting to the end of a project saying, oh, well, we only made 10% gross profit on that. Oops, I guess we'll do better next time. And there's no real process in place to fix it. They just keep doing it.
Yeah. Can you talk to me a little bit about that's on the project level, but on a company level, how should owners be looking at their expenditures and their project costs, all those things over the last, 6, 12 months?
Yeah, it's a good question because the other thing I see is I look at a WIP report or some job costing reports from a construction business, and everything looks great. Our margins are 30 to 40%. We're killing it. We're really profitable at the job level. And then, the question they always ask after that is, well, man, we're just doing so good on job profitability. Why aren't we making any money as a company? Well, okay, let's step outside of the WIP report. Let's step outside of the job costing reports for a second. Let's go look at the P&L. P&L shows that you have a 15% gross margin on your company as a whole. So you're sitting here patting yourself on the back thinking you're earning a 30 to 40% margin on your jobs because your job costing is screwed up. When in reality, your P&L is telling you the truth that you only actually earn a 15 to 20% gross profit on your jobs. Your job costing is broken. It's incomplete. You're leaving costs out of it that should be in there, so it's not telling you the truth. So you need to be gut checking your margin that you think you're getting in your job costing in your WIP reporting to what your actual P&L is saying. And if those don't reconcile, if they're not telling the same story, then you know you have a problem.